Americans have missed out on $603 billion of free money over the past 8 years by doing this one thing. And let me show you just how much money $603 billion is. Let's say this coffee bean is worth $250. This is what $1,000 worth of coffee beans looks like. And this jar is what about $1 million worth of coffee beans would look like. And to visualize $603 billion, you'd need approximately 194,000 of these jars to fill up a regulation football field. And it would take more than 3 full football fields to make $603 billion. That's a lot of coffee. Well, Americans have missed out on all this because they've kept their money in savings and money market accounts at the 5 largest US banks, instead of putting it at a bank with one of the top 5 highest yielding accounts. I'm going to explain how that amount is calculated, why people aren't moving their money, and why savers could be losing a lot more money in the future. Let's get into it. So here's how I did the math. I got a list of the highest yielding savings accounts in the US from Bankrate.com. Here are the current top 5. Then I got data on the amount the bank spent on savings and money market accounts from the Federal Deposit Insurance Corporation. And then I asked Nathan Stovall, a principal analyst for financial sector data at S&P Global Market Intelligence, to help me boil it all down to just the 5 largest banks by deposits. As of the third quarter, those banks were holding more than $2.4 trillion in consumer savings and money market accounts, about half the total held in all commercial banks. I found what that money could have earned in a top high-yield savings account and subtracted it from what it actually earned, according to the bank's data. Then I added up the total from each quarter, going back to 2014 when FDIC first started tracking consumer deposits in these accounts. So why are consumers missing out on all this free money? It's not because the big banks are any safer. Since FDIC insures consumer deposits up to $250,000 on any bank they cover, your money is equally safe at any FDIC-insured bank. I talked to Gary Zimmerman, the CEO of Max My Interest, a company that helps consumers move their money between the top high-yield savings accounts. He told me many consumers don't think it's worth the effort to switch, and many don't know about the superior alternatives. Also, people don't think critically about financial decisions, Zimmerman told me. The big banks have also invested billions of dollars into consumer-facing technology like Zelle and mobile banking that make it convenient for consumers to use their accounts. The banks have invested heavily in this technology because it's still way cheaper than paying higher interest rates. And it's important to note that if consumers did move out of the big banks on a large scale, the banks with the high-yield accounts could lower the rates. No one's quite sure what would happen because it's so much money. But consumers should really think about making the switch, because they're likely to be losing out on even more money in the future. With the Fed raising interest rates at the fastest pace since the 1980s, banks earn a higher rate on their deposit accounts at the Fed. They're able to pass those higher rates on to customers. The ones that don't are able to pocket that money. The third quarter of 2022 was the largest gap between what savers in high-yield accounts and those with accounts at the Big 5 earned in interest. But that difference will probably be dwarfed in the fourth quarter, because rates at high-yield banks have risen along with big interest rate hikes from the Fed. And if rates stay high through 2023, as investors and the Fed predict, that will mean even more money savers miss out on by staying at the big banks. So this pile savers are missing out on could grow a lot bigger. You may not have a lot in savings now, but you can do like Griselda's Benny the Butcher said on Tana Talk 4, turn these breadcrumbs to a hedge fund. That's all for now. See you next time.